A very good morning to all. Myself Fani Sultana, working as assistant professor, belongs to Department of Management Studies, SNS College of Technology. And today we are into the topic that is payoff options on futures under the fourth unit, valuation, the subject, derivatives and risk management. Previously we were discussing about the understanding the payoff fundamentals, and next we will discuss on the what is the long call option on futures, and we were about to discuss the short call on futures. Short call on futures, we have here the four key characteristics should be noted. One is the bearish or the neutral strategy. Previously we were discussing about the bullish strategy. Here it is the bearish strategy. Obligation to, rather there we are going for the buy options. Here we are going for the obligation to sell the futures. Here the formula is payoff is equal to, here comparing to previous slide, payoff is equal to maximum. We had a notation. Here we are adding a symbol that is minus maximum of 0 comma f minus k plus premium. Here we are adding the premium. So here the writer gains the future prices remains at or below the strike prices. Here the premium, we know it is the, we are experience the maximum gain that is limited to premium we have received. The potential loss, that is unlimited, when we can expect the losses is when the F, that is the future settlement prices increases. Next we have the long put option on futures. Here the key characteristics is bearish strategy. Here the right to sell the future options. Then here the contract is exercised when the strike price is greater than the settlement price. Here we are using this contract for the purpose of protective hedging strategy. Here the formula is payoff is equal to maximum of 0 comma k minus f, that is minus of premium. So here this long call option can be compared to the long put option to a certain extent. So here the buyer profits when the future prices falls below the strike prices. Here k minus f gives you the maximum profit. K means the strike price, f means the settlement price at which where the contract is being executed. Here we can expect the scenario that is the maximum profit increases as f is belongs to 0. Premium, that is maximum loss, limited to the premium we have paid. Next we will discuss on the short put option on futures. We know that here the formula for payoff formula is equal to minus of maximum 0 comma k minus f plus premium. Here writer gains, when writer is able to, writer means here they are mentioning about the intermediary, that is the brokerages or trader firms where their future prices remains at or above the strike price. Here the premium gives you the maximum gain limited to premium received. Here high, which means the potential loss if it is belongs to 0. The key characteristics is equal to the, which gives the bullish or neutral strategy, obligation to buy the futures. Profit is when the settlement price is greater than or equal to the strike price. Here the ultimate objectivity is the income generation from the investor point of view. Now let us have a key discussion on the real-time case study. That is, here crude oil futures faces the option during the crisis, that is the year 2020. Let us now discuss this case. In April 2020, oil futures turned negative for the first time in history. The traders holding short put options on oil futures faced the catastrophic losses. So sudden losses has been faced by the traders. So this scenario has happened in the April 2020. In March 2020, what has actually happened is oil futures at $60 per barrel. Traders sell put options at strike price when the dollar that is $30, collecting the premium. What has happened is in the April 20, the future crashes to, that is $37 per barrel. Here the $30 instead of $30. Here we came across the $37 due to the shortage crisis and the demand already which has been collapsed due to the rise of prices. So what is the outcome here is the short put holders faced losses of around $67 per contract plus premium, demonstrating that the unlimited risk has been faced by the trader. Let us discuss the design thinking in the option strategy in the next slide. Thank you for listening the video.